In this Emily Now episode, we're going to be talking about the Canadian Small Business Loan Program, how new businesses are able to get money, or even, existing businesses. We're going to walk through an example of an entrepreneur with bad credit that was able to buy a business, and all of the banks, or the major banks, have put out their major financial results for the second quarter, so we're going to talk a little bit about that as well. My name is Gallagher, founder of mlenow.ca. I'm a finance guy with about 18 years worth of experience in the debt financing world, and each week we put together these Emily Now episodes to help you with the information that you might find at the platform, as well as some general knowledge about borrowing money in either the form of a mortgage or a loan. And we do this because we think that if we can give you good information about the decisions that you're going to make, that you in turn are going to be able to do more. And with some of the information that you learn on these episodes, that maybe you might be able to save some money, maybe invest some money back into your business through borrowing and hiring more people, or maybe through some of the things that you learn, you're able to participate in the local community around you. But generally, we think that these episodes are a good thing, and they're meant to accommodate what you would find going to mlenow.ca. Having said that, you can follow us on Emily Now Canada on the Twitter network. You can find us on Facebook or on Google+. We have a YouTube channel which we'd hope you subscribe to. So let's get started with this episode. And the first question that we have is, what is the Canadian Small Business Loan Program? The Canadian Small Business Loan Program is a program put together by the federal government that most of the banks participate in. What we've learned in our history of helping folks that come through mlenow.ca looking for money for their business is that each bank has a bit of a different policy on how they participate. There's different people at the bank that you're going to need to talk to. But in essence, the Canadian Small Business Loan Program will make up to $500,000 available for either land or a building that your business is going to operate out of, or they'll make available $350,000 to improve a leased space that maybe your business has. Maybe you need to put in walls or counters or offices, or you need to rewire a building or put some signage up. You can get up to $350,000 for that, and or equipment as well. It's available to businesses that do not generate more than $5 million a year, and as long as your business qualifies under that program, that you also can't have more than $500,000 or $350,000 of combined Canadian small business loans within your business. So if you've used the program before and you need more money, you're only going to be able to get to a maximum of either $500,000 for a building or land, or $350,000 for leasehold improvements and equipment. The loans are generally amortized over 7 to 10 years, and to put that in perspective for you, if you go to the bank and get a traditional term loan, usually they'll give you 5 years to pay it back, but under the Canadian Small Business Loan Program, they're going to give you anywhere between 7 to 10 years to be able to pay that money back. And it depends, of course, on the deal. That's our big caveat anytime that we're looking at business financing is, business will say, well, how much can I afford, and what are the terms going to be? And for us, it's always, well, it depends. It depends on what you're financing, how long you need it, how well your information's been put together, the kind of bank that's going to end up looking at the deal. So in this case, it's no different with the Canadian Small Business Loan Program. However, the maximum amount of interest that you're going to pay on either variable rate will be prime plus 3%. So today prime is 3, so 3 plus 3 is going to give you 6. It'll be a 6% loan. Or if you go with a fixed rate, meaning it's not going to change as the prime rate changes, then you're going to end up getting the residential mortgage rate for that time, so the posted rate, plus 1.25%. So at least when you apply under the Canadian Small Business Loan Program, you're going to have maybe higher interest costs, but you're going to have a longer period of time to pay it off, and the criteria for approval is not quite as stringent as it would be if you went to the bank directly to go and get a small business loan. I should point out, because this becomes a pretty big bone of contention with borrowers, that they have to pay fees and fees and fees and fees. There is a fee associated with this program, and it's a one-time registration fee that can be up to 2% of the amount that you're going to borrow. And you're not going to pay that fee every single year, but when you apply for the program through a bank, you're going to end up paying that fee. So the Canadian Small Business Loan Program, we've done a few of them for people that have come through mlenow.ca. The criteria is there for them to get done, and the banks participate in the program to various extents. And what we've typically found is it's just hard to find someone at the bank who will actually understand how to take your information, hopefully in the form of our deal package that you would get through mlenow.ca. But even if you went by yourself, it's pretty hard to find the person, the individual at the bank, at the branch, that's going to be able to take your information and really help you take advantage of this program. So we would encourage you to always make sure that you're prepared. Make sure that you've got your business plan put together, that you've got your financial projections, that you've gone onto the internet to do some research on what the approval criteria is for the Canadian Small Business Loan Program. We, of course, at mlenow.ca can help you through that exercise. We can help you put your documents together. We can help make sure that you've got all the questions answered and that your numbers make sense. So like anything, the key is to be prepared. And if you're going to apply for a Canadian Small Business Loan, make sure that you're talking to somebody at the bank who actually has either done one before or can put you in touch with somebody at the bank that has done one before, because it can be very frustrating to think you're dealing with someone and then only you get voicemails and emails and you're sort of left on your own. So that's the Canadian Small Business Loan Program. Moving along to question number 2. This is a great question, I think, but what are the sources of money for a business? And depending on the stage that your business is at, so it's either a new business, it's an operating business, it's an operating business that maybe had some financial turbulence and now has been able to get things back on track, or you're buying a business, or you're buying out a shareholder. I mean, there's so many different moments of time that your business can be in, which changes the type of money that your business would be able to access. But here's generally how it works. When you're starting a business, you typically will use your savings and or your credit cards or any other personal resources that you have. If you're building a piece of software, for example, you might choose to do the programming yourself. If you're looking to start a little retail store, then you might end up getting a couple of extra credit cards to try and help finance some of the early costs that you're going to have. But once you've exhausted your savings and your credit cards and your personal resources, you tend to move into what's called family and friend money. So now you call up, your rich aunt or uncle, and you say, I've got a business, and this is kind of where I'm at with it, and so now I need some more cash to put in, and hopefully they're happy to do that for you. But once you move past family and friends, usually you've proven the idea by then, or not, but generally speaking, once you've used your credit cards, your personal savings, any of the other resources that you might have, plus your family and friends money, generally speaking, you've been able to prove that you have a business. And if you do, then kind of the next series of steps are generally angel investors. So these would be investors that invest in new businesses that have some measure of traction to them, or venture capitalists if you're a little further down the road. There's also kind of a new category that has come up in recent years, which is crowdfunding, and you can refer to some of our other Emily Now episodes to learn about what that is. Those basically are online portals where you raise money from a crowd of people. So if you're looking for, say, $100,000 for your business, you'd go onto a crowdfunding website, post your opportunity, and then people could put in $1,000 or $2,000 or somehow participate in raising the money for you. Once you've gotten over that amount of capital and your business has now progressed to that level, then you start looking at banks, or you start looking at investment funds, or you now start looking at maybe borrowing money as opposed to just asking people to put it in and giving up maybe some of the profit. But the key is always to know how much you need, what you need it for, and how you're going to pay for it. In addition to having a business plan and financial projections, you definitely should know how you're going to make money and how the business is going to pay for itself, because all of those answers and all of those things help you understand what kind of money you need. What the advice I've generally given to businesses, because we work with mlenow.ca, our focus client is anyone looking for 10 million or less. So that tends to be small businesses, it tends to be people who are maybe refinancing their house to take the money to invest in a business. But generally what I say is, if you don't know how you're going to make money and you haven't proven out the revenue yet, and you don't really know who your customers are, and there's just a bunch of unknown, then you're going to want to raise equity as opposed to debt. And I'll speak to that in just a moment. There's two types of money in the marketplace. There's money that you have to repay and make monthly payments on, and you're on the hook for it. That's called debt. There's other money that is exactly the opposite of that, where someone will give you the money, you don't have to make payments on it, but in exchange for that privilege, they're going to want a piece of the profit or a piece of ownership. So equity, debt, debt, equity. The advice I've given people, and businesses in particular, is if you don't know many of the important things about your business yet, you don't know your profit margin, you don't know your customer, you don't have kind of enough traction to really figure out with any certainty what life's going to look like, then that's when you would take equity. You would take equity because you're prepared to give up some ownership for the risk of the unknown and not have to make regular payments with an interest rate and use up all of your cash flow. However, if you do know some of these things, you do know who your customer is, you are proving out revenue, you have some results that show you with a certain amount of certainty that, yep, I think this is what our business is going to look like, then debt might be an option, because in exchange for debt, you don't have to give up any ownership. You can keep all of the profit. So the idea is that if your profit's going to be greater than the cost of borrowing the money in the form of interest, then you might want to take on debt. But that would only be in the case where you do have some measurable handle on what the result is going to be, because there's no point taking on a big loan and having a creditor breathing down your neck if you don't really know how you're going to pay them back or what the mechanism is going to be for paying them back. So those are kind of the options for how a business is going to end up finding sources of money. It's going to start with your personal savings and credit cards, and it's going to move into family and friends and rich uncles and aunts maybe. Then you're going to move into maybe crowdfunding or angel investing or venture capitalists, and then at that point you probably are going to start looking at maybe some sort of debt financing or subordinated debt, or trying to get a bank involved. So lots of options out there. We would encourage you to visit mlenow.ca to kind of get a handle on what debt would look like. If you punch in the amount of money you think you need, you're going to see the payments and the amount of equity that's going to have to be in your business. And if you don't have that, you're going to have a plan that sort of shows that. So mlenow is a great resource for you to take advantage of if you're looking for money for your business. And there's lots of other options out on the internet to learn about it. It's a pretty well-covered topic out there in the internet world, in the internet land. Lots of blogs, lots of videos. And so take advantage of those free resources if your business needs money. We're going to talk now about an entrepreneur that we came across on the mlenow.ca network who was bankrupt in their past and was looking for financing. And so they weren't looking for equity, they were looking for a loan. They thought that maybe they could that a bank would lend to them based on the strength of their idea, even though their credit wasn't in place and they didn't have any net worth. Unfortunately, their bankruptcy was a series of poor decisions and unfortunate events, but nevertheless, they came through mlenow.ca looking for financing, and because they didn't have any net worth, because their credit was really poor, we couldn't put them in a debt option. Banks, it's important to know, banks don't want to own your business. They really don't. They're in the business of lending money. So they borrow money from people at a usually at a low cost, and then they turn around and lend that money out. So their upside, the amount of profit that they can make, is limited by their interest rate. As a result, they're not interested in investing in your business if you don't have any money in the business. And even if you have a great idea, they still can't lend you the money because they need something to lend against. They need assets, or they need security, or they need some way to realize that value out of your business. And if it's only an idea, but they're paying for the equipment, and they're paying for the staff, and they're paying for marketing and websites, and they might as well just start the business themselves. So that's a really key distinction to know, that banks do not want to own and run your business. They want to make interest off of the money they lend to your business. So in this particular case, we said, look, we can't give you a debt option because there really isn't anything here to lend against. And but if you come up with a different scenario, or you come up with a different option, we'd love the opportunity to try and help you. So God bless entrepreneurs. This entrepreneur, being who she was, she went out and found a business that said, look, you know, we've run this business for 20 years, me and my wife. We'd really like to get out of the business, but we're not eager to get out of the business. So you seem like somebody that has some history, and even though maybe in your past you went bankrupt and life didn't work out for you, we feel more comfortable lending to you because of those things that had happened to you, because now, if they happen again, you already know what to expect. We know what we have in working with you. So tell you what, we'll go and borrow some money against the business to cash out, to put some money in our jeans, and we will allow you to pay us the rest of the money in the future. And before you take any profit out of the business, and before we give you full ownership and control, the loan that we get from the bank, the payments will have to be made out of the revenue of the business before you get a percentage of the profit. And so in this particular case, we were able to give some guidance to the vendors and to the purchaser to say, here's probably how a deal comes together. It's very typical for private enterprises or for private businesses to structure their deals this way, where someone says, look, I want to buy your business, and the owner will say, great, let's go to the bank, let's get some money from them, we'll keep a little bit of money in so you can pay us later, and then you put some money in. So it kind of works out to be the bank will give a third of the money, the current owner will keep a third of the money in the business to be paid out at a later time, and then the new owner will come in with a third of the purchase price, and between all of those thirds, they end up having a business transaction. So it's important to remember that the banks don't want to take all the risk. In this particular case with this entrepreneur, even though they had a bad track record, financially speaking, they were still able to put a deal together where they could get the business that they wanted. It was going to have a cost to it, so they were going to have to pay some interest on some money that the bank was going to lend in, but ultimately they were able to achieve what they wanted to achieve. And so if you're a business owner out there who maybe has had a bit of a scarred past, the beauty of being an entrepreneur is to simply seek out opportunity. And if you yourself can't borrow the money or access the cash that you need to start the business that you want to start, then maybe you have to take a different road and find a business that's already operating that you can earn your way into or work your way into, and often you might find that that option was a better option all along. And so if you need money to finance that, and you have a business that's willing to sell you their business but maybe not require all of the money, then a lot of times you can borrow against that, and go to mlenow.ca because we'd be happy to help you with that. Some updates in the market this week. The major banks released their second quarter results, and everything looks positive. Scotiabank, I think, took probably the lion's share of the headlines because their results were really good. But BMO, TD Bank, RBC, they're all excited about the news of kind of how the second quarter went. Obviously, a sign of the times. I think if you look around the Canadian economy, things generally speaking are kind of stable to good. They're not maybe excellent, and you know the heydays maybe aren't here, but you know, generally speaking, I think things are okay. Because I've been doing this for so long, I've got 18 years of working in the debt market in particular, and working in small transactions, even to even narrow it down a little bit more, small being less than 10 million. History teaches me that it's the third quarter results where the truth really comes out. And so I've noticed year over year over year that the first quarter, not a lot of excitement. Second quarter tends to be the big announcements where everything looks amazing and earnings are being exceeded and revenue is great and net income is really good. And then it's the third quarter where it gets a little spooky and a little shaky. So of course, very excited for all the banks, great for Canada. Everything's, it's all wonderful. But my real question is if you took the time, and you should, if you're looking to fall asleep at nighttime, you could pull open the financial statements from each of the banks, and in particular look right at the profit and loss statement, and you can see kind of where they make their money. But it's interesting to see all of that. And my question is, even though these results are good, where is the real growth coming from? I think that if you look at the news, you'll see that Scotiabank actually attributed a lot of their great activity to what was happening overseas. And that's good for them. TD Bank mentioned that their operations in the US still are kind of not really doing as well as they would have hoped. And then RBC and BMO just sort of indicated that everything everywhere is great and wonderful. But in what we're seeing every day, I can't really get my hand on, or I get a handle on rather, where all of the excitement and where all of the growth is coming from. Banks really only make revenue two ways. They borrow money from you and me at nothing, and then they lend it out and make the difference. The second way is through offering other services like ATM charges, bank charges, wealth management, kind of all of their other ancillary services. So those are the two ways they make money. And are these good results because the banks are doing really well themselves, or is it because the general economy is holding them up? And I tend to think it's just the general economy holding them up, because I'm not really sure that we see banks being incredibly innovative anywhere. And if they're making more money, if they're actually bringing in revenue, that's a good thing, although the growth there I think is pretty minor. But if they're cutting costs to make more money, then that tells you that maybe people are being laid off, or there's new technologies that the banks are employing to try and save more money somewhere. So it's great that the banks are doing great, but I don't really see that it's attributed to anything of value. I think that in what we do every day, because we're dealing with small businesses, transactions that are less than $10 million, it's kind of still a grind out there. It's pretty tough to get residential mortgages. Banks make it very tough to get mortgages for homes today. You'll notice the changes with the vacation homes and the rental properties and self-employed people. I mean, these changes are going to catch up with the bank results somewhere. Maybe not obviously in the second quarter as we've just seen, but I think it's going to happen here in the coming future. And for businesses, it's not as if banks are bending over backwards to give money to businesses. Now, I put a lot of the burden on the businesses because I think generally speaking, private businesses are not well prepared when they go talk to their bank. And banks do have money to lend to them, but banks aren't really doing anything to help private businesses figure out how to access the money. So I don't see a lot of growth opportunities there. So anyway, those are my comments for what it's worth. It is interesting to see how the banks make their money, and I hold this opinion that governments don't really want banks lending money or taking risks, and banks are more seen as a bank vault as opposed to centers of innovation and creativity and really trying to figure out how to spur anything to the next level. But that being what it is, I would just I'd say, hey, that's a good job for the banks, and let's see what the third quarter brings us, and start thinking though, if you're someone that looks at banks to make investments, or you buy their stocks or their shares, you should be considering though that the changes happening in the residential mortgage market, which have been really huge. One by one they're not huge, but collectively the changes are huge, and at some point those are going to figure themselves out, and so maybe now's the time to take some money off the table with the banks if you happen to own their stocks. Thank you for joining us on this Emily Now episode. We'd encourage you to visit mlenow.ca if you need a mortgage or a loan. It's pretty simple. The banks and lenders do want to lend money to you at the mlenow.ca web portal. You can punch in a loan amount. You can see what it's going to take to get the money. You can see which banks are going to give it to you. You can send your request to us to help you get the money from the banks, or you can send it directly to them on your own. We've got live chat. We've got real people behind the website that are available to help put your deal together, whether you're looking for a mortgage for a home, money for a business, or you're looking at making a commercial property purchase of some sort. We'd be happy to help you with that. So thanks for joining, and we'll see you on the next episode.